I want to break this video down into two parts, and the first thing that we're going to go over is about finding opportunity in the market. And this is a very key concept because when you find opportunity, you have to take it. And for this to make sense and for the strategy to kind of tie together, let's go over the pre-market plan. I post these every single day in the Discord of setups I'm watching and levels that I'm looking out for. So yesterday, the day prior, May 1st, which was Wednesday, we had FOMC. My main levels was 50.44 and then 51.14 to the upside. If 51.14 can break, then I'm expecting a move into 51.27. So these levels you see on my screens were there before the market opened up at 51.27, 51.14, and the demand zone at 50.44. The market opens up and we see a pullback down into this demand zone. Now the market comes into this demand zone, and my plan was if this can hold, I'm interested in taking this thing long, targeting a high a day. Offered great risk to reward, offered great confirmation, and I took it long at 50-50 with a 2-point stop loss going for a 12-point reward. It was a 6-to-1 risk to reward ratio. Eventually, the market pulls back on me, and I stop out of this trade for a $250 loss. Not the end of the world, right? Well, directly after I stop out, the market rallies, and I missed out on the opportunity. Now, later in the session, the market pulls back, holds the demand zone, holds 50.42, right, on multiple different tests. And then we eventually get the rally that I want, and the small losing trade, what I consider to be break even, could have been a solid winning trade. Then we get FOMC, Jerome Powell's press conference, the market rallies up into our resistance level and then gets a very strong dump to the downside, and we form a new key level at 50.90 from large sellers on the tape. If anybody has a time in sales or a level 2 or a footprint chart or a heat map, go back to 50.90 to 5100 and you will see large aggressive selling there. So that is a level that I've marked for the following day, which is today on May 2nd, Thursday. The point I'm trying to get here is I posted something on my Instagram about finding opportunity in the market. In fact, if you're not following my Instagram, I recommend doing so. I'll post a link in the description below. Click it. You'll be able to follow me. I post daily trading recaps on here, along with really good trading tips and tricks that I guarantee you're not going to find anywhere else. But on here, I essentially posted that there's nothing worse than finding opportunity in the market and not acting upon it. I had a plan for this trade down here at the level, and I took one losing trade, and it made me a little fearful of not entering it again at some point in the future, which is something that I never do. The greatest risk is not having any risk in the market, and this is something that kind of bled into today, the day after this 50.90 to 5100 level formed. Now today, May 2nd, the pre-market plan, I was watching 50.90 to 5100, which is this pink level that I just explained, that I will be looking for sellers here, that if sellers reappear, it's going to offer opportunities to play short, targeting 50.70. Now if 50.70 breaks, that's going to lead into more downside, targeting that 50.44 demand zone that bounced the market the day prior. It bounced so many times that usually levels that hold on multiple tests usually get tested again to test those buyers or sellers to see if they're willing to be active in the market again. So in the overnight session, guess what happens? The market rallies right into 50.90 perfectly. It was the high of the session as I'm recording this, and we dump down about 30 minutes before the market opens up. Now the market opens up, and directly from the bell, we can see very large selling pressure. And this is going to come now into my strategy of how I implement this risk management system that helps me have small losing trades and even larger winning ones. So going over my intraday commentary, again, this is just where I update my thoughts in real time of everything that I'm watching, and any trade that I am taking, win or loss, is posted in here. The main thing 1 minute at the bell was I was not very bullish at the open. In fact, I was a seller at the open. I was watching for VWAP to break. I was watching for the rejection to bring more sellers in the market and fuel a move down. Now here's my issue, and this is where things get a little sticky, and this is a very good lesson for a lot of traders. For me personally, I am not a fan of playing breakdowns because breakdowns do not offer the best risk to reward compared to playing reversals. So my main thing was I was watching for a rally up to short a rally up into the green line, that if sellers could appear, I would be interested in playing short, targeting that demand zone lower. The issue is is that the selling was very strong and the market never got that bounce without me. Now, today is an exception where playing a breakdown would have worked very well and chasing the market would have made you money. But you can't look at one trading session. Maybe you make a mistake one day and you try to tweak your whole trading system because of one trade or one day. One setup or one trading session is not good enough to tweak your trading, right? You have to have more data than that. So the market sells off. And by the time I was like, okay, sellers are really strong here, it was all the way down here at the 75s, the 78s, right? For me to get short at one of these ovals, my stop loss would have to be near this high or a break above the 50-90 level. So I'm getting short at the 78s, 74s. I'd be risking like 16, 17 points, which means I need to make at least a 32, 34 point reward to the downside. Now, is that possible? Yes, because we did get it today. However, the chances of it happening are not as likely on a daily consistent basis. So when I see the market like this move without me, I rather wait for a rally up because the rally up would offer the best risk to reward. If we got a rally up, let's just say back up here into these 84s, then now I could base my risk off of the 90s where my risk is smaller and my reward is much larger. So we kept dumping down and it never really gave me an opportunity to short the market down. Now I'm just going to go over my commentary so you all could see exactly what was in my head as it was developing. My main setup now, 15 minutes in, was if we can get above the 50-70s, but not above the 50-77s, I'm going to be looking to short the pop. This kind of validates exactly what I just said of shorting the pops because they offer the best risk to reward. So here's the 50-70 ones, and keep this level in mind because this is going to be a very significant role at a future setup. We keep dipping down, and again, I can't chase it now here at the 62s. My risk is way too much. It breaks down even more. I can't chase it here at the 56s. And we kept selling off and kept selling off, and guess where we hit at 50.44, right? We sell off right into that demand zone where the market had bounced at the day prior on that FOMC, where I missed that long opportunity. Then we get a rally up, and this is where things get interesting, and this is where the strategy gets involved. Throwing my computer in the dumpster. I was pretty frustrated at this point, missing all these opportunities. That was a great opportunity. Do not FOMO into other setups. The market hasn't even been open for 30 minutes. There will be other opportunities. So now the market sells off, and we came into the demand zone. And at one point, I was not watching for longs. And this is an important lesson about flipping the switch when the market tells you to flip. Never be so bearish. Never be so bullish. When the market tells you to be bearish or bullish, then go with those flows. So what I saw here about 10:15 was a very large buyer appear in the market. Now, what I mean by that is as the market was trying to move up, some large trades were hitting the bid and price was holding. So now I had a thesis that as the market was selling off into the demand zone, I wanted buyers to hold and support the market around 50.46, 50.47, 50.44. This is just general area right over here of consolidation around 50.47, 50.45. Keep that level in mind now. We get a move up, and around 10.22, when the market rallies up like this, there is a ton of consolidation, which is holding this previous low right here, coupled with aggressive trades hitting the bid, yet the market was not selling off. So at this point, I was comfortable taking the market long right here at 50.49 with a 2-point stop loss, call it a 1.5 stop loss for a 11 to 20 point reward. Imagine having such a great entry because I'm confirming my setups through the tape that it enables me to have a 1.5 to 2 point stop loss. That goes with having great entry points. Now, when my stop loss, and this is the strategy that I've really want to be implementing a lot more into my trading. It's not something that I normally have done. So I'm long here 50.49 with the stop loss under these 50, call it 50.48s, just to be simple with this, right? 50.48s. So I'm long with a 1.5 stop loss. If I'm wrong on this trade, and let's just say I trade my normal size, I actually wrote this up. 2-point risk on my normal, I trade about 15 full-size ES contracts, would be about $1,500 loss with that 2-point risk, right? but I'm way more comfortable losing more than $1,500 because my average loss when I hold to my stop loss is around $2,000 to $3,000. So having a 2-point risk enables me to size up. And I traded this with 25 contracts because it enabled me to size up. But still, even though I sized up, my risk was around my average losing trades, around $2,500. So yes, I sized up, not because the position was a high quality one, but I sized up because my risk was smaller than normal. And what enabled me to have my risk smaller than normal was a great entry point, confirming this setup through the time and sales. So I'm in this trade long when the market looks like this. We're pulling back into the level. Then we get a strong move up. I sell 75% of my trade into the 61s. And then I sell the remainder 5 contracts as this thing is rejecting VWAP and showing signs of weakness. But I don't want you all looking at the profit because yes, it's nice making solid profits, but the concept here is adjusting your position size relative to my risk. If my position size was 10 points away, trading this thing with above average size would not make sense. It would make sense to size down on that setup to compensate for the risk. If my risk was 1 point here or 2 ticks, maybe I could have traded this with 35, 40 contracts. And what this does is it makes my risk, if I lose on the setup, about average to what I am normally losing. But if I am correct on the setup, it's going to make my wins above average. And this is how you're going to be able to compound your growth significantly by adjusting your position size relative to your risk. Now, going back to the opportunity aspect, I know there's a lot of little lessons and gems that I'm going over here. I rather take a setup with the risk of being wrong rather than missing a setup with no risk at all. There's been a lot of setups and it's been very frustrating if I have to be completely honest. Like I can't sit here and act like I'm, trading extremely well. There's been a lot of setups that I've been missing recently that I've had a plan for, that I just simply did not get an entry point, whether I missed confirmation or whether I walked away. So it's been frustrating seeing the market do exactly what I had planned out for and follow my strategy perfectly, but not having real skin in the game and not making money on it. So losing on a trade for me right now is a better feeling than actually missing an opportunity. I'd rather take a $2,000 loss than miss a setup and see I could have just made an extra $10,000. So after that setup, guess where we pull back into? We pull back right into these 46s, right? Right back into these 46s that we were watching for the market to hold at, right? Pulled back into it perfectly, and I missed the setup. It rallied 30 points from it, and I missed the setup. Later in the session, a few minutes before I started recording this video, remember what I said about the 71s? We were looking for a rally up earlier above the 71s to short the market, short a pop targeting the 60s. Well, guess what? The market broke above these 50 70s, failed, and pulled back over 25 points. Now we're testing this level again. So there's just so many opportunities, and I feel like this is kind of like a double-edged sword. Like I don't know if it's okay to miss these opportunities because of it's showing how well the strategy is working and how powerful the levels that we can all create are. But there's really not a worse feeling in the market than seeing your levels trigger and you not taking a setup off it, whether I miss it or just didn't find valid confirmation. When it hit these 70s, I didn't see valid confirmation for me to take it. It wasn't that I was scared to lose money on it. It was more so that I was just not finding valid confirmation when it hit this level. So if you find opportunity and you get confirmation, take the setup and adjust your size relative to the risk. Those are the 2 gems that I want to leave you all off in this video. If you learned something from it, I would appreciate it. If you're new, subscribe to my channel, drop a like on this video, and comment any questions. Peace.